Hi everyone. One fund over 270% in the last decade. Another crashed 80% from its peak. Both were called safe investments. I'll tell you which is which in exactly 90 seconds. But first, you need to understand why most investors get this dead wrong. They chase what's already won. They buy at the top, they panic at the bottom. The wealthy do the opposite. They rotate before the crowd. They buy what's hated. They sell what's loved. Remember that all investing carries risks, so do your own research. This is not financial advice, and I am not a financial advisor. Here's what Wall Street will never tell you. Markets move in cycles. Always have, always will. Growth dominates for years, then value takes over. Tech runs hot, then dividends outperform. This isn't opinion. This is 100 years of market history. The S&P 500 has alternated between growth leadership and value leadership in predictable waves since 1927. Nobel Prize-winner Eugene Fama proved it. Value stocks beat growth 93% of the time on 15-year rolling periods. Let that sink in. 93%. But here's where it gets interesting. Right now we're at a turning point. Growth stocks have dominated for years. The Russell 1000 growth returned 389% over the past decade. The Russell 1000 value? Only 196%. That's a massive performance gap. And you know what happened the last time we saw a gap this wide? The year 2000, the dot-com crash. Growth stocks collapsed 50%. Value stocks, they went up. So here's the controversial truth nobody wants to hear. If you're still pouring money into the S&P 500 index funds, you're buying at the top. The index trades at 22 to 30 times forward earnings. That's higher than 2021. That's approaching the levels we saw before the 2000 crash. And here's the kicker. Technology stocks make up to 35% of the index now. 35%. When tech corrects, the entire index bleeds. The wealthy aren't buying index funds right now. They're rotating. They're moving capital from expensive growth into cheap value, from speculation into cash flow, from hope into dividends. And there's one specific way they're doing it that retail investors completely miss. Let me introduce you to SCHD, the Schwab US Dividend Equity ETF. This fund tracks the Dow Jones US Dividend 100 Index. It holds exactly 100 companies. Not random companies, not speculative companies, companies that have paid dividends for at least 10 consecutive years. Companies with strong fundamentals, high cash flow to debt ratios, high return on equity, growing dividends. The fund yields approximately 3.5%. Compare that to the S&P 500 at barely 1%. The expense ratio, just 0.06%. You keep almost everything you earn. But wait, here's what makes SCHD different from every other dividend fund. The index methodology is ruthless. It doesn't just pick high-yield companies. It screens for quality first. Financial strength, dividend sustainability, then it ranks by yield and dividend growth. Only the top 100 make it. And here's the beautiful part. It rebalances annually. Weak companies get cut, strong companies stay. It's self-cleansing. Now let me reveal the second fund, VYM, the Vanguard High Dividend Yield ETF. This one takes a different approach. It holds nearly 600 companies, massive diversification. It targets stocks with above-average yields across all sectors except real estate. The yield sits at around 2.4%, lower than SCHD, but still double the market. And the expense ratio? An insane 0.04%. That's $4 per $10,000 invested annually. Here's the math that changes everything. Take $10,000, put it in SCHD. Based on the fund's historical performance since inception, you're looking at approximately 13% annualized returns. That's $10,000 becoming $34,000 over 10 years with dividends reinvested. But here's the real magic. That entire time you collect cash, hundreds, then thousands in dividend payments. Money you can spend, money you can reinvest during crashes, money that compounds. Compare that to growth stocks. Sure, they might double faster in bull markets, but what happens when the cycle turns? You watch your $100,000 become $50,000. No dividend to cushion the fall. No cash flow to buy the dip. Just hope and pray that it recovers. That's not investing. That's gambling. Now here's the part that separates amateurs from professionals. Asset allocation. Most people mess this up completely. They go 100% into one thing. All growth or all value. All stocks or all bonds. That's how you get destroyed. The pros balance based on age, risk, tolerance, and market conditions. If you're 35 to 45 years old, here's the allocation. 60% S&P 500 for growth exposure. 30% SCHD for dividend income and stability. 10% international value for diversification. This gives you upside while protecting downside. If you're 45 to 55, shift the weights. 50% S&P 500, 40% SCHD, 10% bonds or cash. You're prioritizing capital preservation now. You can't afford a 50% drawdown 5 years before retirement. If you're over 55, get defensive. 40% SCHD, 30% VYM, 20% bonds, 10% S&P 500. Income becomes your priority. You need cash flow that doesn't depend on selling stocks at market lows. Here's why this allocation is bulletproof. When growth crashes, your dividend positions hold steady. When value underperforms, your growth position keeps you in the game. When everything drops, your bonds and cash become buying opportunities. You're never fully exposed to one risk. You're anti-fragile. But there's a deeper strategy most investors never grasp. Dividend stocks aren't just about income. They're about behavioral protection. When your portfolio pays you $500 a month in dividends, you don't panic sell during crashes. When you're collecting cash flow, you think long-term. When you see dividends growing every year, you stay disciplined. The income changes your psychology. It changes how you think about volatility. Let me give you the real secret. The S&P 500's dividend growers have returned 10.2% annually over the past 50 years according to Hartford funds. Not dividend stocks in general. Dividend growers, companies that increase their payments every single year. SCHD specifically targets these companies. That's why the fund's holdings have averaged 8 to 9% annual dividend growth over the past 5 years. Think about what that means. Your income doubles every 8 to 9 years. You start with $10,000 generating $350 annually. In 8 years, that same position generates $700. In 16 years, $1,400. In 24 years, $2,800. All from one initial investment. That's the power of dividend growth compounding. Here's what's happening behind the curtain. Institutional investors rotate billions from growth to value before retail investors even notice. Pension funds, endowments, sovereign wealth funds, they don't chase returns. They position for the next cycle. When you see value starting to outperform, institutions already moved 6 months earlier. By the time retail investors pile in, the easy money is gone. So here's your action plan. First, audit your portfolio right now. What percentage is growth? What percentage is value? If you're over 70% growth, you're dangerously exposed. Second, start dollar cost averaging into SCHD or VYM immediately. Don't wait for a dip. Don't try to time it. Start building the position today. Third, reinvest every dividend automatically. Turn on dividend reinvestment in your brokerage account. Let compounding do the heavy lifting. The investors who execute this strategy over the next 12 months will look back in 5 years and realize this was the turning point. The moment they stopped chasing and started positioning. The moment they stopped gambling and started investing. The moment they built real lasting wealth. Disclaimer, this content is educational, not financial advice. All investment carries risk, including potential loss of principal. Consult a qualified professional before making decisions. This is Invest ED, building wealth the boring way that actually works. Smash that like button and subscribe for strategies Wall Street won't tell you. Smart investing, profitable results.